Hello everyone, this is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, July 13th, 2026. So a recap of economic info last week as we previewed. Very light schedule, thankfully. It was very easy and nothing impactful. So we started off last week on Monday. ISM Services Index, now again 50 is the demarcation line, so above 50 good, below 50 not so good. The consensus was for June, 54.2. That's where it came in, 54.0. Then on Thursday, initial jobless claims. The expectation was 219,000, came in a little bit better. 215,000, that's great. Existing home sales also on Thursday. That's a little disappointing, but again, doesn't really move the markets. But the expectation for June was 4.2 million. Existing home sales came in at let's call it 4.1. So economic data, really nothing last week. And we'll see as we go through the rest of the slides here, really the markets didn't move much either way last week. Inflation expectations didn't move at all. Well, a basis point. So prior week, 2.23% rose to 2.24%. And that's the expectation of average inflation over the next 10 years with the 10-year break even, 10-year treasuries minus the 10-year tip yield. GDP expectations for the second quarter, the Atlanta Federal Reserve refined their number just barely. The week before, they were at 1.2% GDP growth for the second quarter, moved that up to 1.3%. Now, the Fed funds futures market, that did change a little bit last week, so we have a Federal Open Market Committee meeting later this month. I believe it's the 29th, and that will be the rate decision. And the expectation for one rate hike actually did increase. It had been 22%. That moved up to 36%. But by the end of the year, this is a number that really has changed quite a bit over the last several weeks. The odds of no cuts, well, we're not getting any cuts, but the odds of staying where we're at is now only 13%. Just a couple of weeks ago, that was 40%. So now we have 36% odds of one rate hike, 35% odds of two rate hikes, and then 16% probability of three or more hikes. Now let's take a look at how the markets did last week. Again, no economic activity, nothing really moved. Did have a good week in U.S. equity market with the S&P 500 up 1.3%. That was driven by the Mag 7. I believe the same thing was the case week before. Mag 7 last week, equal weighted, our weighting of it, 3.8%, up 3.8%. So solid week in U.S. equities. And now on a year-to-date basis, S&P 500 up 11.4%. And I'll add here, the Invesco equally weighted S&P, broader measure, up 12.8%, so that's great. Top performer in the U.S. has been small cap stocks. So Russell 2000 now up year-to-date 20.7%. And that Mag 7 that I mentioned with a very strong week last week, barely up on a year-to-date basis, up 3.2%. International stocks now disconnect from the U.S. solid week. International, not so much. Developed markets ex-U.S. down 1.1%. And emerging markets were down 1.7%. Now, and this is the first time we talk about this relationship quite a bit, that last year both developed markets ex-U.S. and emerging markets outperformed the U.S. That had been the case earlier this year with the S&P. Not at this point in terms of the developed markets ex-U.S. Again, with the S&P 500 up 11.4% on a year-to-date basis. That is better now than the World Index, the Developed World Index ex-U.S. barometer. Now, the Emerging Market Index has continued to outperform the U.S. On a year-to-date basis. That's up 21.7%, despite the fact that China is down on a year-to-date basis 11%. Fixed income last week, not a great week. So you had the 2-year yield plus 4 basis points, and the 10-year plus 7 basis points. So the Bloomberg U.S. Aggregate Bond Index was down 44 basis points last week, which leaves us on a year-to-date basis absolutely flat, up 4 basis points. Well, now let's segue, take a look at the economic data that will be released this week. Likely a more impactful slate of economic indicators. Now, tomorrow starts off big, underscore big. If I didn't mention big, a large inflation reading tomorrow. It is the CPI and CPI core for the month of June. The expectation for the headline number in terms of a month over month, and this is pretty impressive. This has been moving up, of course, with Iran and the gas price situation. So for the month of May, this indicator was up 50 basis points month over month, 0.5%. For the month of June, it's actually expected to be down 0.1%, with gas prices coming back a little bit over the last month or so. The core CPI number, however, on a month over month basis, actually expected to accelerate. So for June, it's expected to be up 0.3% month over month, whereas in the month of May, that was up 0.2%. So we follow that up the next day by PPI number, producer price index, both the core and the headline number. So the headline number month over month is expected to improve dramatically. Month of May, that was up, and this was a bit of a shock, that was up 1.1% month over month. For June, that's expected to have dropped to 0.2%. The core number, ex food and energy month over month, is expected to be up 0.4% month over month, same as it was in May. On Thursday, we'll get initial jobless claims as we always do. The expectation is 218,000. Again, last week was 215,000. We also get retail sales ex auto. I'll just mention retail sales are expected for the month of June to be at 0.3% after a very strong, very hot May reading of positive 0.9%. On Friday, we have 3 indicators that really don't move the stocks anymore: building permits, housing starts, and the Michigan consumer sentiment. So we'll just leave it there. You can read the numbers, but not expected to move in the market. So that's it for our economic recap for last week and our preview of this week. We thank you very much for attending. We look forward to seeing you next week. Thank you.